Talking about the steel industry, though, SAIL, that's the first management on the show. Remember, the company reported actually a softish set of numbers in the first quarter. They missed what the street was working with. I caught up with the company's CMD, Mr. Amrindu Prakash, and I quizzed him about the soft showing in the first quarter and also asked him, what's the way ahead? Let's listen in to what he had to tell me.
From the street expectations to the actual numbers, there is only one gap. The gap is in stock valuation impact. CPLY, we have had a stock valuation impact of 1,080 crores. Even if I say normal inventory of 500 to 600 crores, the 500 crores number which has gone out because of stock valuation is the only change. And this is just an accounting entry affecting us only for this quarter. So the year projections remain strong, remain positive. In fact, this stock valuation impact also indicates that we have brought down our cost. And because the inventory is valued at cost, so that's why this hit has come. But it gives us confidence that our cost reduction measures are working.
Got it. All right. Let's take it now piece by piece. We take forward your clarification on board. What is the volume growth you're looking at for this year? If you could quantify it.
Yes, we have planned a volume growth of 8% CPLY.
Okay, so you're confident, because the last time around you had mentioned about 8%, but now you're confident that you can achieve that. Now, since you're saying that this valuation impact is just for the past quarter and things will look up from here on, let's dissect it a little bit. What about realizations? In quarter two, ideally it should be softish because of the monsoon. How do you see realizations move for the coming quarter? And also, if you look at the cost of coal, what was the fluctuating between quarter four and quarter one? And in quarter two, how will it compare to quarter one?
So, coking coal costs have been range bound. So, if we look at Q4 and Q1, there is not much to pick up on. It has remained stable. Going forward, also, we see the same trend continuing. There is no fundamental factor which should affect coal price going forward. So, profitability going forward will depend on two things. One thing is volume, and second thing will be the cost efficiencies that we accrue, which are sustainable. Both, as I said, we are planning a overall volume growth of 8%, which we are confident of achieving, as well as the cost reduction, which I said has worked. If I compare with previous year Q1, the costs are better now through efficiency. And this push we are going to continue. Another factor which is coming in is we have commissioned a program to improve our digital presence. The implementation of Industry 4.0 in our operations is ongoing. We have taken a target of adding 1,000 crore per annum to the bottom line purely with our digital initiatives. So this will go on accumulating as we go forward in this year.
1,000 crores to the PAT number because of digital initiatives?
PBT number, because purely on account of digital. In fact, the program we are working on, the payments are linked to actually achieving these numbers. If these numbers are not achieved, no payment will be there.
No, that'll be interesting, and we'll track you on that one, sir. But since you're focusing on the cost efficiencies, and there's going to be volume growth as well, according to your calculations on an EBITDA per ton basis, what number are you satisfied at?
See, but we look at currently 10 point something number in this quarter. If I take out the valuation impact from next quarter onwards, it should automatically jump up by 2 to 3%, and a further 2 to 3%, I'm confident can come from the cost numbers.
All right. So instead of EBITDA per ton, you're giving me the margin number. Last quarter, it was in the vicinity of around 10%. In the coming quarter, it could improve by around 200 to 300 basis points, and post that another 200 to 300 basis points in the second half of the year. So ballpark, in margins, are going to be moving from around 10% to more than 15% by the time we wind up the year. Got that. One positive in the numbers actually was your net debt number. You know, in the last few quarters, it's gradually been coming down, which is encouraging. But you have a capex plan as well to satisfy. So could you tell us what was the capex you spent in quarter one? For the year, what is the outlook? And where does your net debt end the year at?
Net debt, if you see last year, last year we were able to bring down our net debt in spite of the challenging times that we were facing. In quarter one, further net debt has gone down by 1,100 crores. By the end of this year, we will hope to get that overall number, to the tune of 4,000 to 5,000 crores. Last year, we did 5,900 capex, which was ordinary capex, not really going towards expansion. This year, the number is increased to 7,500. However, the real capex towards capacity expansion will start coming from FY27. It is not expected in FY26. Not much expenditure will be there. So reducing our debt further by 5,000 crores is the target in this year. And from next year onwards, we will start seeing debt will increase because our capex on the ground for the expansion programs will start hitting us.
And in terms of capacity, what does it mean? Where are you headed?
Going from 20 million ton today to 35 million ton by the end of the decade, that is by 2030. So overall, next 5 years, we'll be increasing our capex numbers.
And this will be at a capex of nearly around 1 lakh crore?
Approximately, yes.
All right, that's a tall ask. Then, if that is the case, this 20 to 30 million tons, sir, you can do it by a couple of other measures, right? You have a couple of PSU units. Maybe they get folded into it, which will get you closer to the target. NMDC steel is there. RINL is there. I can see you have something up your sleeve, sir. Is that a possibility?
These companies are by the government, so the government has to take a call. As a company, we are always happy to take up more responsibility and improve volume. We believe in the steel industry, mergers and acquisitions are a big part of steel industry's expanding. And we, if given an opportunity, will be willing and happy to do that.
Okay, interesting. But have the government hinted there could possibly be a merger between all these assets, SAIL, NMDC Steel and RINL?
You hear as much as I hear, so difficult for me to comment on that.
Well, sales numbers fairly disappointing, but the management guiding for better terms ahead. They're saying for the year, volume growth will be 8%, margins will improve by 200 basis points in the coming quarter, and post that another 200 basis points improvement, and net debt will reduce by around 5,000 crores because the capex for expansion starts only from the next year. Stock ended down 4% yesterday.